Marc Faber, the editor and publisher of the Gloom, Boom, and Doom report. He's spending the day in our Mexico City bureau, and this afternoon he'll speak at an event co-sponsored by Bloomberg. The title of his speech, by the way, is "When Everything Else Fails, Policymakers Can Always Be Assured of Immortality by Making Spectacular Errors." So let's get right to it. Marc, thanks for joining us. There's a lot of talk about policymakers here in the U.S. because of the Dodd-Frank regulation. What do you think, though, are the most spectacular errors, or the policymakers we can look to make the most spectacular errors globally?
Well, I think a big error is obviously to print money. I think it doesn't help in the long run. It can give a temporary boost to economic activity, but it doesn't lead to sustained economic growth. In fact, it creates a mispricing of assets and of goods and services, and has negative implications on the price mechanism. In other words, say you print money, that can be done, but what the central bank, or in the case of the US, the Federal Reserve, doesn't know is where the money will flow to. So it flowed into NASDAQ stocks before March 2000, and then into the housing market and created the bubble. And then in 2008, as the economy went into recession, we had a commodities bubble when oil went from the day they cut interest rates in September 2007 to July 2008. Oil went from $78 to $147, which was like an additional tax on the US consumer to the tune of $500 billion. And lately, the money printing in the US hasn't actually helped much the asset that the Fed would like to boost, namely housing, where it created other bubbles overseas in currencies and again in commodities to some extent.
Hey, it's interesting that you mentioned that, especially combined with housing. We spoke to a wide spectrum of people over the last week, including Barton Biggs, Christy Romer, and others about this. Bob Schiller, speaking of housing, listen to what they had to say about monetary policy.
If house prices keep falling, I think there's a fairly good probability that he's not going to end QE2, and there may be a QE3.
I find it very worrisome that all of the talk recently is maybe we should be dialing back on QE2. And I think if you look at the overall state of the economy, it is still a very troubled economy. I think the hope of any more fiscal help is very small. In fact, we're likely to go to fiscal contraction. So the Fed should be thinking about what can we responsibly do to help this economy heal more quickly.
I would be a little wary of cutting back on QE2 with mortgage rates up a little bit and home prices down, and the construction sector is a big part of the volatile part of the economy. We're not out of the woods yet, so I think they should consider renewing or expanding it.
I firmly believe that we will see QE3 at some point. We know that this Bernanke-led Fed is willing to be extremely aggressive, but the question is going to be, what's the catalyst?
So even now, the bearded bear, David Rosenberg, thinking that QE3 is a possibility. What do you make of this? Is it going to happen?
For sure, there will be QE3, but not right away. I think the Fed believes that the economy is recovering, and some sectors of the economy are actually doing quite well. And overseas, we have strong growth, in particular in emerging economies. Like I'm here in Mexico, the economy is doing very well at the present time. So I think they will do QE3, and my view is they will do QE3, QE4, QE5 until QE26, until the whole system breaks down. And obviously, the question is how fast they'll do, and to what extent the stock market has already expected this QE3 or the end of QE3. I think QE2 is now fully discounted. I don't think that the market will go up significantly. In fact, I believe the Fed would like to see stocks correcting somewhat, and then have an excuse if stocks are down 20% to say, yeah, we need QE3.
Are you still calling for a 10% correction in U.S. equities?
Well, basically what happened is we made a peak at 1344 on February 18th, and then we dropped to 1249 on March 16th, and now we're back to 1330 essentially. And April is a month of seasonal strength, so I wouldn't rule out a new high for the indices. But if you look at the individual stocks, a lot of them are rolling over, And if you look at the price of copper, that has correlated very well with the equity markets since 2009, then the price of copper also looks as if it had rolled over. So when I look at the various sectors in the market and analyze, what is driving the market higher, it's been largely recently energy and energy related. The oil servicing stocks this year are up 20%. And other stocks have, as I said, corrected already, and most stocks are actually no higher than they were in January or in November.
Well, and I want to get your view in terms of valuations of the U.S. market. But first up, I want everyone to listen up to Michael Arenstein, who we talked to just recently and talked about U.S. valuations. Just listen up, everybody.
The great overarching value in the world is the United States. This has become pretty much the cheapest major economy on earth. If you looked at the cost, somebody who was spending yen or Swiss francs or euros to buy property in the United States or to own an office building or rent office space or create a factory, we're priced now almost like an emerging market economy was 8 years ago.
Mark, one of the reasons we love talking to you is because you are out there in the emerging markets. You like the emerging markets. You're laughing. Do you agree that the U.S. is priced like an emerging market 8 years ago?
Well, the thing is like this. I started to go to Latin America in the mid-'80s and to Mexico in late 80s. And I'm amazed at the changes that have occurred today, say, in the 70s and 80s, if you went to New York, Los Angeles, San Francisco, Miami, and then you went to Latin America, there was a huge difference. And today, Mexico City is a fantastic city. It's a very beautiful city. And the Mexican economy is run actually with very prudent fiscal and monetary policies, much more prudent than in the US. So I would say, yeah, the US has become an emerging economy, but the very bad one, whereas others are better. And then when you talk about valuations, you just before discussed the telecom shares. In Thailand, I can buy you some telecom shares that have a dividend yield of 7% and sell at, say, 9-10 times earnings. So if someone tells me the US market is very cheap, I can say, where is the growth today in corporate profits? It's largely in emerging economies. And so I want to be essentially positioned in emerging economies. Now, can the US market outperform emerging economies for a while? Sure. But in the long run, the growth prospects of emerging economies that had problems in the 80s, problems in the 90s, they are now realizing that through prudent economic management, they can achieve a lot. And I'm really surprised how well the Mexican economy is doing and actually how low inflation is compared to, say, in the 80s when inflation was occasionally close to 100% per annum.
And Mark, let me ask you, before we get to the U.S., what you think about specifically investing in our could be, should be greatest trading partner, really, Mexico.
Well, I was skeptical because I had been to Mexico many times, and I have to say I'm very positively surprised by how society has mutated. And of course, Mexico has a drug problem, but the criminality is among the drug dealers and their gangs and is more concentrated in the north. Mexico City, in fact, is rather safe. And I would say this, if someone comes and tells me that the US is so unbelievably cheap, I can buy here in Mexico City really a top condo, around 250 square meters, in the best location for, say, around $1 million US. I don't think you can do that in New York City. I don't think you can do that in Hong Kong, London, Singapore, and so forth and so on, certainly not in Switzerland. So all I want to say is basically this is an economy that is largely misunderstood. It's the 13th largest economy in the world. They have low inflation, prudent economic management. And what is happening now is something very interesting. 10 years ago, wages in Mexico were 270% of wages in China. Now they're 45% higher. In other words, here the wage level has remained relatively stagnant, and in China wages have gone up a lot. Now this means that over time, Mexico will obtain more manufacturing jobs simply because of the proximity to the United States. So I think this is a very important point to consider longer term. And I think the stock market here is not particularly expensive. I don't think it will go up a lot because, as I said, I think markets will correct.
You know, when you talk about longer term, Mark, another thing that you point out, and I'm looking through your research note, you talk a lot about the U.S. fiscal situation. You say the fiscal situation of the U.S. is extremely dire, if not hopeless. You're really concerned. You've got some great charts. You know, charts that we've seen at Bloomberg often. You also write U.S. Treasuries are going to be a horrible long-term investment. In fact, back in December, you said they're, I think, a suicidal investment.
Yes.
How quickly do we need to get our fiscal house in order before it really runs out of control? Are we already at that point in your view?
I think you made a very good point. The US is already out of control. It's going to be very difficult, and I want to explain to you why. A society has to be patriotic. Patriotism doesn't mean to go and invade Iraq and Afghanistan and bomb Libya with mercenaries. Patriotism means making sacrifices. And every interest group in the US has to make sacrifices. But the US and other countries as well, I have to point this out, has evolved into a society where the corporate sector wants as much as they can in terms of corporate profits. The financial sector wants as much as they can through their relationships partly with the government. And the unions want as much as they can because they see how the banks and the large multinationals rip off the system by not paying their due taxes, as GE is doing. So what kind of a society is it? If I'm a labor union leader or a worker that is in a union, I will also insist on having higher wages, because each time I get a higher wage, it's eroded through money printing by the Fed, through higher energy and food prices.
Mark, let me ask you, in terms of the money printing by the Fed that you talk about, if the Fed stopped QE2 today, what would be the impact on the market? Since the market's so expected to keep on going, what would be the impact? And I just got about 45 seconds here for you.
Withdrawal.
Well, I suppose the market would go down, but a market is designed to go up and down. That is the purpose of having a market economy. If you don't want to let markets go down, you have to print money.
Right.
And in QE2 more money, and in QE3 even more, because the marginal impact diminishes. So QE3 to really push up the market would have to be much larger.
Mark, we talked about some of the calls that you've made that were right on the money, including that March 2009 low. You also, though, write in your research about our forecasting records are horrendous. But you talk about kind of how tough it is in terms of predicting what's ahead in the future. But where would you suggest investors put their money at this point?
Well, I think that depends very much on the investment objectives. But I believe that what is undesirable is US dollars cash. Because as you've just heard, the Hoenig said the Fed fund rate should be 1%. In my opinion, the Fed fund rate today should be 5%. And that would keep prices from rising and accelerating, and it would provide real interest rates. At the moment, we have negative real interest rates. Secondly, I think long-term US government bonds are undesirable unless it is for a rally. Maybe in the next 1 or 2 months, if stocks sell off, government bonds could rally somewhat. So you have essentially real estate, equities, commodities, and precious metals that you could consider as an investment. And in precious metals, you could also include, say, art and stamps and diamonds and so forth. So I would say an investor, he should have at least 20 to 30% of his money in precious metals. I think they may also correct. I don't think the breakout in gold above the highs between November and January, that was at 1425, are very convincing, so we may have a correction. But in the long run, with Bernanke at the Fed and with Mr. Obama, maybe another 6 years at the White House, I think gold will go up substantially.
That's because, Mark, that's because you don't think the Fed is ever going to raise rates even to 1 rather than 5, which is where you'd like to see them, but you don't think it's realistic, right? Because if everybody is long precious metals and that happens, that's a real problem.
Well, I don't think the Fed will increase interest rates to a positive real rate. In other words, say cost of living increases today in the US, depending on who do you believe, are between 5 and 8% per annum. That's essentially the basic inflation. And the interest rates are at zero. So even if the Fed goes to 2%, in real terms, we're still at negative, say, 3 to 5% interest rates. And I think one day maybe the Fed fund rate will be at 6% and inflation at 12%. So in that environment, you don't want to own cash, you don't want to own bonds, you want to own equities, and you want to own precious metals and maybe some real estate.
But the reason I ask is because I wonder what effect it would have on the markets. And a viewer writes in and says, "What do you make of the liquidity risk in the markets today?" Because he sees everybody on one side of the trade. Everybody long precious metals. Everybody long ag commodities. Everybody long certain currencies and short others.
Listen, calm down about everybody being long precious metals. I know more people that sold their gold already than people that have increased their positions. And I go to lots of conferences. I usually ask the audience, how many of you own gold? In some audiences, it's maximum 5%. I've been to audiences where not a single person owned gold. And my daughter, she lives in Germany. She walks by a shop when she goes home from work. She says people are lining up to sell gold, their jewelry. So I don't think that it's a gold bubble. In fact, when someone earlier said that America is very cheap, I was going to say maybe actually gold is very cheap in comparison to the money and credit that has been created, and in comparison to the size of financial asset markets in the world.
You did, by the way, last time you were on with us, January 25th, you said that you thought at the time America was oversold. You thought people should move out of emerging markets and get into the U.S. Equities for the next 3 months or so. Do you still think that's a trade that should be on?
Well, I'm very cautious now about all asset markets. As I explained, the price of copper has been weakening, and technically markets don't look very convincing. I think maybe we won't even make a new high in April, and if we make a new high, we'll have a more significant correction in May, June. Because I really think that many Fed members, board members, and also Mr. Bernanke, they're not going to announce right away QE3. They know what the risks are by now. And the risks are obviously higher commodity prices, higher food prices, higher oil prices, and the weaker dollar and so forth and so on.
All right.
I'm sorry,
we're
Matt.
all stepping on each other. Marc, thank you very much for joining us. We really appreciate it. Marc Faber there in Mexico City.